This is the Value Investor Podcast with Tracey. All things value, all the time.
Welcome back, value investors. So I was looking around at the chemical stocks the other day, and they've been on my mind ever since Dow Chemical said that they were cutting their dividend. And then I recently did Eastman Chemical as a bear of the day here at Zacks. You can find the bull and the bear of the day every day the market's open on Zacks.com. It's just right on the front page there, and you can click on, you can see the old articles too if you want to go into the archives a bit and see which ones are the bulls, which are the Zacks number ones, strong buys, and which ones are the bears, number fives, strong sells. Now, I know you're asking, why would I want to look at number fives and, why even consider those? Because occasionally as value investors, we do find some deals there. I guess you could call it deals, bargains, stocks on sale, maybe some opportunities. Because remember what the Zacks rank looks for. It does look for changes in the earnings estimates. So number ones are seeing revisions to the upside where something good is going on and the analysts are going in and raising what the earnings are. But the number fives is the flip side. Maybe something not quite so good is going on, and so they're cutting. And remember, number ones are about 5% of all Zacks ranked stocks, and number fives are also 5%, but on the negative side, right? But remember, the Zacks rank changes daily, and so a number five one day may be a number one another day, usually not the very next day, but it does change frequently, and eventually, hopefully, the analysts are raising estimates on a stock that was a number five. So that is very volatile, and the rank can change quite a bit. But I covered Eastman Chemical, as I mentioned, as the Zacks bear of the day. And it did get me to be thinking about all the stocks that are in the chemical industry and what is going on there. Are there any deals? Are these values at all, or are they traps? Because they all do have very low PE ratios. So it is a good exercise, like we do with the oil stocks, like we have with the banks, to check in with some of these chemical stocks. Also because many of them, if not basically almost all of them from the ones I'm looking at, are trading at or near 5-year lows now. And we are going back into 2020, the pandemic year, not right at the beginning. Obviously, we're more towards the end of 2020 now, and we're about to get, in a couple of months still, but we're about to get the announcement about the Pfizer vaccine, and that really sent stocks soaring when that came out. So if you are currently around, what was happening in August of 2020 was still not that great, but off of the March lows for sure. But some of these stocks have round tripped and are all the way back down. And what I was stunned by when I was looking at Eastman Chemical for the bear of the day was that they said in their second quarter earnings report in end of July that these 4 years have been terrible. Basically, that it's not just a recent slowdown in business that they're seeing, that, the challenging macro environment, as they all keep saying, but this is year 4 of it. So it's not surprising that finally these stocks are breaking down. They're all kind of in the same situation. The chemical stocks can be very cyclical, but the chemical stocks are the building blocks. These guys are the building blocks of manufacturing. And so when they see a slowdown like this, it's definitely signaling recession. But we have been in a recession in manufacturing for a couple of years now. So this is all lining up. But as value investors, I know many of you are starting to take a look at this group, as I did when I looked at Eastman, to just wonder, Are there some deals here? There definitely are some interesting dividends and dividend yields. What's going on with that? Should I be buying here? Is this the low? And, is this a value or is it a trap? Now, remember, whenever we do this episode, value usually means what it says, that it has low PE, low PEG ratio, low price to sales, maybe price to book. We're looking at like classic valuations for the actual value, but a lot of traps can look like that too. They can have low PEs too. So the trappiness side is really about the earnings. Are the earnings rising or are they falling? Are they expected to have some rising earnings next year versus this year, or are they expected to decline further next year? Then if they are expected to decline further, then you get a bit more of the trappiness situation as we've discussed. So let's just talk a little bit about the chemical industry because we've never really covered it here, I don't think. But it is Eastman Chemical is just in the industry of chemical dash diversified on Zacks.com. And it is the bottom 4% of all the industry rank. So that's, other than being 1, 2, or 3% at the bottom, that's very, very low. So it's 234 out of 245 industries. That means most of the stocks in it are seeing some kind of estimate cuts, most likely. And just looking at the entire industry, you can click on the link there up at the top on the quote page. It's by where it says industry rank. You can see that it's clickable there. And this industry has 28 stocks in it, which is actually quite large. And it currently has no Zacks number ones, not a surprise. Only one Zacks number 2, which is the buys. It has 12 number 3s, which are holds. It has 4 number 4s, which are sells. And then it has 11 number 5s. That's a lot. That's what gets us in the bottom 4%. But something, pretty severe is going on in this entire industry, which Eastman Chemical confirmed in July in its earnings report that it's been 4 years now of struggling, waiting for the turnaround that has not yet come. And now they're also dealing with tariffs on top of it. A lot of these companies are global in nature, so a lot of materials and products moving around. They have manufacturing in many places. They might be able to mitigate some of the tariffs by moving some manufacturing around at their various facilities, but not all, and not everything can be moved. So a lot of balls in the air for these management teams. But let's talk a little bit about a couple of the Zacks number 5s, the strong sells. I decided to focus on those because there's so many of them and because Eastman is a number 5 strong sell. And a lot of these stocks are at their 5-year lows or near their 5-year lows. But I'm going to also talk about the Zacks number 2 stock. That's the only number 2 in this group, just to kind of give you an idea of why someone else is a number 2 and these others are number 5s right now. So Eastman Chemical, let's start there. E as in Edward, M as in Mary, N as in Nancy is the ticker. And over the last year, these shares are down 22%. Over 5 years now, they're down 5.6. And S&P 500 is up 95.3 in that same 5-year period. So this is where buy and hold gets difficult, right? Even though you're getting a dividend. So this does not include dividend. But the dividend on Eastman right now is yielding 4.9%. That's pretty nice. Dividend is $3.32 a share. They were paying it last quarter without any problems. But you never know if earnings continue to decline. So that's another thing you have to worry about with some of these is can they actually pay that dividend? Earnings expected to decline 21.9% this year, but again, they are struggling. And next year, though, a rebound of 16.4 because at some point it has to end, right? But the analysts were more bullish a couple months ago about 2026 and even 2027, which is showing up now. And they have been cutting those estimates. So for 2025, 5 estimates have been cut in the last 30 days. For 2026, 5 have been cut. And they're only giving quarterly guidance right now because that's how bad the kind of what they can see into the future is right now. There's too many balls in the air. So they did guide under consensus. So the estimates are down for the third quarter as well. They've been cut, but still, the guide was pretty low. They guided at $1.25 and they were at $1.83, the analysts. So earnings keep getting cut, and hence you got the weak share price. You are getting that dividend, but will we really see this bounce back into 2026? So they're looking for 717 for next year, but just 60 days ago they were at 815. So it's already been cut down $1 after that last earnings report. So there are still risks involved here because the companies themselves aren't saying that they're seeing a bottom. That's what makes me worried. And that's what gives it more of the trappiness. Now, even though earnings are coming down this year, so that's a bit of a trap for valuations. So they have a PE of 11. That is cheap, but their PEG is 6.5 because those earnings keep coming down and it's negative earnings growth this year. And then next year we'll see, but those estimates are also still being cut. So the number 5 strong sell is warranted here. And the algorithm is flagging this because it does see the difficulty in what is going on just with these earnings estimates. That's even before you read what they actually said is going on. So that's Eastman Chemical, EMN. But as I suggested in the bear of the day, I like to keep these things on my watch list because eventually the earnings will turn. Hopefully, I mean, I've never seen 5-year type of recession for the chemicals. Let's hope not. But until it turns, I'm staying out of Eastman, but I am keeping it on my watch list. So Eastman Chemical, EMN. The next one is Dow. I mentioned it because they did cut their dividend. So that's pretty dramatic. You don't see that every day, but a lot of these companies are trying to cut costs. They are shareholder friendly because they always have been in their histories. And so they know to keep you sticking around, they've got to keep this dividend up. So they are willing to be paying something for sure. And but in Dow's case, it was just too much with given where earnings are going. So they don't want to get themselves into some other kind of troubles. And so they cut it 50%. And it's now $1.40. But even with that 50% cut, it's still yielding 5.7. Before they cut it, it was yielding 11%. So 5.7 still, even with the cut. But expected to, let's see, the dividend is $2.80. And this year, expected to make, no, they're losing 83 cents. Next year, just 23 cents. So you can see why they had to cut it, right? So keep that in mind as well. Estimates down on Dow, similarly to Eastman, also a number 5 strong sell. 3 estimates down in the last 30 days for 25. 2 are down in the last 30 days for 26. And so now they're expected to lose 83 cents, down from a loss of 43 cents just 30 days ago. Prior to that, they were expected to be in positive earnings. So this is turning kind of quickly here. They did have a big miss last quarter. So Again, the struggle is kind of real. I know many of you have been looking at Dow because you can't believe where it is and how much it's down. 1 year down 54.4% now, and it is trading near those 5-year lows. So, but I'm not seeing a turnaround in this one yet either. So I'm keeping it on my watch list. This is a trap. Trappiness is going on here to some extent. And we also have the tariffs and everything else going on. So yeah, I'm not a real fan of Dow either. Okay, then we're going to do one I haven't looked at in a long time. Stepan Chemicals. It's just Stepan. The ticker S is in Sam, C is in Charles, L is in Larry, SCL. It is a number 5 again. And this one, small cap, 1.2 billion market cap. The other two were mid and large cap companies, but this is a smaller cap, very highly specialized. They do surfactants and polymers, specialty products, including things for the beverage industry, among other types of food-related things. And these shares also near the 5-year lows, 1 year down 34.8%. They do pay a dividend, $1.54, yielding 3%, so a little bit less. But in the fourth quarter of last year, 2024, they did raise the dividend by 1 cent, but a raise is a raise, and they've raised it 57 consecutive years. By the way, Dow Chemical has paid a dividend, not necessarily raised it, but paid one since 1912. 456 consecutive dividends. So that's amazing. Love the track record, but these companies are committed. This is like the old economy, right? And so they've paid for many years, and Stepan also paid 57 years. Even again, if it's just a penny, they will continue to do that. So sales in the second quarter were actually up 7%. On higher selling prices, but this was passed through. They passed through the higher raw material prices, and so they had higher selling prices, so sales were up. But we're seeing similar things with the earnings on Stepan, even though each of these has their own products and certain niches. But we only have one estimate for Stepan because, again, small cap company. Earnings expected to be down 2.7% this year. So we're looking at $2.14. But just 90 days ago, that estimate was $3.29. So you can see how quickly it's coming down. For the third quarter, we're looking for 36 cents now, but 30 days ago, it was 96 cents. So they're really coming down because they have to right now. Things are not looking good. And they also had a big miss last quarter. So this one's a little tough, but 2026, expecting a rebound of 87%. So from 214 up to 401. That sounds good, but one estimate is lower for next year as well. In the last 30 days, none are higher. And the 401 is down from 443 just 30 days ago. So this one's, like I said, also is X number 5. It's not as cheap on a PE basis. It's trading at 23 times. So maybe it has to go even a little lower, and only getting a 3% dividend yield with Stepan. But you can see just from looking at these three how difficult and how industry-wide the issues are in the diversified chemical companies. And so that's why it's got, the fourth, it's in the lowest 4% of the industry rank as well. But it's always dark before the dawn, as they say. So now let's have some better news, shall we? And look at the number 2. It is Johnson Matthey. Matthey? The ticker is J as in John, M as in Mary, P as in Paul, L as in Larry, Y, JMPLY. It is traded on the over-the-counter because it is foreign. They're headquartered in London. So there's specialty chemicals, but they specialize in marketing, refining, and fabrication of precious metals, including platinum, noble metals, catalysts, chemicals, and refining. They do clean air, among other things, and they did say that they're selling their catalyst technologies now to Honeywell, though. They expect to return at least 200 million pounds per annum to shareholders. So again, they are very shareholder friendly, and they kind of know they have to be, being the old economy here and struggles that are going on in this kind of industry. But you can see this one is a little bit different than some of the others, even though it's in the same industry, but their focus on like platinum and the precious metals is a little different. Now they too do pay a dividend. And like I said, they're devoted to returning money to shareholders. We have it as $2.88, and that's yielding 5.6%. So that's pretty juicy. Remember, with foreign countries, you may have some tax implications there. Not sure how they're paying it out and all that stuff. So be sure to check into those things if you are owning any foreign companies. What do the earnings look like? We only have full year because it's foreign, but we do have 3 estimates. So that's good. It's not just one. Market cap on this one, 4.3 billion. So kind of mid cap-ish. I guess it's a smaller mid cap. PE 12.9. So we do have on the cheaper side. And again, for the year, Zacks consensus is looking for 396, and that's up, but only 3.9%. Next year, looking for 389, so it's down a little bit, down about 2%. But we don't have anybody cutting. We have one analyst raising in the last 30 days, and so that's where we're getting the number 2 buy designation. But even for this year, this fiscal year, it's, like I said, 396. It has come down from 423 just 90 days ago. So even there, a little bit of a struggle going on as well. And it looks like, they're selling off that catalyst. So not sure what that's going to do to all of their, earnings and things as we go forward. So PEG ratio just 3.1. So not real cheap there, but cheaper on the PE side. 1 year, it's actually up 20.1%. And year to date, it's up 57.5%. So a bit different than what we're seeing with the number 5s, as you might imagine. And this is a good example of what does happen with the Zacks rank. It is designed to get us those better, more high quality stocks with the rising earnings estimates. And you are definitely seeing that between a number 2 in the chemicals versus the number 5s in the same industry, because it was pretty gloomy there, gloomy for the first part of the podcast. Now, I know many of you are kind of sniffing around, like I said, in these stocks, probably not in Johnson Matthey. But you definitely have been tweeting at me about some of the others that are in it. Take a look at what other stocks are in this grouping. You're going to have to go back and look at their earnings reports, of course, and try to see what's going on. A few other names are Air Products is a number 3. There's DuPont in there. I didn't look at DuPont this time. Chemours is in there. They're a 4. Huntsman is a 4. Olin is a 3. These are all pretty big, well-known names. I'm still looking here. Well, those are the ones you probably know the best. And there's more than just, I'm going to look up another one. There's more than just the industry of chemicals diversified, because yes, I just clicked on a company that I know is not on the diversified list, and there's another industry that's just chemical specialty. Now, why isn't Stepan in the specialty and why is it in the diversified? I don't know, but the chemical dash specialty is the bottom 22%, so not quite as bad. But the stock I just clicked on is the Zacks number 5, and it's trading near the 5-year lows too with declining earnings. So this is just a hard industry all around. Doesn't matter which category you're in, but specialty has a couple of number ones. It has 3, and then it has 3 number 2s. But the specialty can be a lot of different things. So, and not quite as much of the like kind of big company exposure as you're seeing. There's some fertilizers in here. I'm looking at this list. And so if you're looking just for like the bigger kind of equivalent to big oil, that's the chemicals diversified that we were just talking about. So I'm sticking over on that category, but I'm keeping all these on my watch list, and you should too, because that's what value investors do. We do like stocks where everybody's rushing out, and especially ones that have long-term track record, but be careful on the dividends. Again, we already saw the cut by Dow. They are committed to these dividends. These are old economy companies, but if we see a 5th year of really tough industry conditions, it's going to get even tougher for some of these companies. So, you got to really know the management, know what's going on over there, and then we'll see. But they're cyclical. And hopefully we see a turnaround soon, because that can mean a turnaround in manufacturing in general. So let me recap the stock tickers again. So there's Eastman Chemical, ticker E as in Edward, M as in Mary, N as in Nancy. Then we had Dow Chemical, or it's just Dow now. And Dow is DOW. Then we had Stepan, S as in Sam, C as in Charles, L as in Larry. And then we had Johnson Matthey, J as in John, M as in Mary, P as in Paul, L as in Larry, Y, JMPLY. They're in London, but they're the only number 2 by stock, and there are no number 1s. So they're the highest ranked stock in the chemicals right now. Shares are up sharply on the year as a result. So be sure to subscribe, because I'm going to be checking into some more of these industries that just are not good. Maybe I need to look at the bottom 1%. What's in there? I don't know. It could be interesting. Maybe we'll find some values there, but I'm always seeking them out, as you know, and I'm bringing them to you every week. So make sure you get us. We're on YouTube on the Zacks Podcast channel. It's a separate channel from our main page, just Zacks Podcasts. Go subscribe over there to get all of our podcasts, except the Zacks Market Edge, which is on the main page, and that's the video podcast. But all the audio podcasts are on the other podcast page, so you'll get a lot of great information, especially in Nina Mishra's ETF Spotlight is there, and then all of the value investors. So get us over there, get us on Apple, get us on Spotify, anywhere else you can get these podcasts. We're probably there, but get us somewhere, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.